few weeks ago, we discussed Jim Simmons' Markov process, which we dissected from the book. This time we're going to discuss something else, which is not only used by Jim Simmons, but even Albert Einstein. So in order to do that, first I want you to go to this page, number 84 of the book, The Man Who Solved the Market, which is what we are trying to dissect. So by identifying comparable trading situations and tracking what subsequently happened to prices, they could develop a sophisticated and accurate forecasting model capable of detecting hidden patterns. For this approach to work, Axcom needed a lot of data, even more than Strauss and others had collected. So Axcom and Strauss were some of the employees or professors who used to work with Jim Simmons. So they began to model, Strauss began to model data rather than just collect it. So note the word model, it's in italics. So in other words, to deal with gaps in the historical data, he used computer models to make educated guess as to what was missing. So this is exactly what we're going to do here. They didn't have extensive cotton pricing data from 1940s, for example, but maybe creating the data would suffice, just as one can infer what a missing jigsaw puzzle piece might look like by observing pieces already in place. So when you don't have data, or when you have limited amount of data, you can create new data, and more data means more backtesting, more research, more optimization, more training data, more testing data, and more conclusions that your strategies can work. So I'll give you a simple example. So this is a chart of the SPY, and if you're looking at the financial crisis from 2008 to 2011, you've got enough data, and obviously you can apply roughly different kind of strategies to see whether it works or not, but that is only a certain amount of data points. So for example, 3 years or 252 days on a working year, number of working days in a year, so roughly almost 750 amount of data points. And we actually, let's say, backtest a strategy and it works, but is that enough? You know, is 700 data points enough for us to conclude that this specific strategy works? So that's what we're going to do here. We're going to simulate data. We're going to create more and more data, so that once we create all these data, then we can apply our quantitative research tools and find our core strategies that works, and then we can apply in any recessionary environments like the 2008, 2011, or even now, and see that it works. So we're going to discuss 3 models here, and 3 models facilitate 3 different outcomes, but at the end of the day, all these 3 models serve one purpose, and that is to generate more data. So each model has got its own positives and its own negatives. So as we go through the video, we'll explain to you what the positives and negatives are, and then you can do what you feel is right accordingly. So first, I want you to go do the Anaconda, open up your Anaconda file. So if you don't know anything about Python, I would suggest you go to our YouTube channel and watch the video Algorithmic Trading Zero to Hero in Python. So that's for complete beginners who don't know anything about Python. You can start from the basics, from just installation all the way to backtesting a strategy or functions and for loops and all those things. So once you're thorough with that video, then I would suggest you do the Markov process as well, because that's a completely different idea, completely different methodology, and this one is a completely different idea as well. So let's go into the code of the Python file. So first we're just going to do is we're just going to import the library. So the y-finance library, the pandas library, the numpy, the matplotlib, the seaborn, and everything, and then we're going to download the data. So we're just going to do the SPY data, and then we're going to download the 2008 to 2011 data, because as you know, we're trying to mimic the recessionary data. We're trying to get as many data points as which has got the similar behavioral characteristics of the recessionary data points. So once we download the data, we are going to store the closing prices to the another thing called close prices, and then we're going to calculate the percentage close. So for that, we're just going to do percentage.change, and then we're going to store that into the pandas data frame and store it to df. So if you can print df, you've got a closing price. So basically what we're going to do is we're going to do 3 models. So the first model will be a simple model, and then we're going to do a geometric Brownian motion, and then we're going to do a Heston model as well. So here's the first model that we're going to do. So this is just plotting the DF, just the plotting the the daily closing prices of that 2008 recession till 2011, and then return as well. So now we're going to calculate the mean and standard deviation by just using ret.mean, ret.standard deviation. Ret is the data points we've got. And then we're going to calculate the mean and standard deviation. So since we've got the mean and standard deviation, now we can simulate data with it. So ret.shape or shape 0 is just to calculate the number of rows, so we know the number of data we have. So SPY now is trading around 400-ish, so we're just going to put the starting stock price to 400, and then we're going to put the np.random normal, because we need to have a normal distribution. So what we're going to do is we're going to simulate data based on normal distribution. So again, we've discussed the probability distribution thingy and how we can generate trade ideas from that, and that video is also there on our channel. Once we find out the simulated data using the mean and standard deviation, we can plot that data. So now we've got the simulated stock price, and we've stored that into a data frame as well. So here we've got a simulated stock price, and we can change the index. As you can see here, there is no index specifically. So we're going to put the same index that we have for the DF, and then suddenly we've got a new simulated stock price. So that is just one simulated stock price. So you understood how simple it is to create a simulated stock price just by using a normal distribution and by putting in the mean and standard deviation. So how about we create 1,000 simulations of this data? So then we've got 1,000 different data points. So that's 1,000 into 750. So that's 750,000 data that we've got, which we can use for our quantitative tools. So here again, we have, this is again just plotting the simulated stock price here. So what we're going to do is we're going to have a for loop, and we're going to run this 1,000 times, and we're going to plot the whole thing together. So basically it's just the same thing we discussed before. It's a random normal function, and then put in the mean and the standard deviation, which we calculated specifically for the recession. So if you don't want the recessionary period and instead just want to focus on the uptrending market, then you can change the data completely and find out the mean and variance from there. So then we can just plot all these lines. We've stored it in simulated stock price, and we are just plotting it. And as you can see 1,000 simulated data price. And all these simulated data price is stored into simulations MC. So we put simulations MC. Simulation MC stands for Monte Carlo because this is a simple Monte Carlo model. We've also used Monte Carlo on our course, but that Monte Carlo simulation is for trades to see our trading strategy works or not. This simulation for Monte Carlo is basically for generating data similar to the data between 2008 to 2011. So then you can just put in simulation MC.4, you can put MC.3 or whatever, so you can see different prices being generated every single time. And all these simulations, we can use it to create strategy. So now we've got a closing price of a completely different data, and we can apply our trading strategy on this data. So I've given you an example on how to do trading strategies once you get these closing prices. That again is there in the Algorithmic Trading 0 to hero in Python. Once you get the closing prices, how to calculate simple moving average or whatever strategies that you feel like doing, you can do it once you get the data. So this video is purely about getting get as much as data as possible so that you can perform your backtesting. So this, what we discussed, is just a simple Monte Carlo model. So Monte Carlo model also has the assumption of a geometric Brownian motion. So what is a geometric Brownian motion? So geometric Brownian motion is this equation which has got a constant mean and constant variance. That's one of the biggest assumptions of a geometric Brownian motion. So what Albert Einstein would say in respect to Brownian motion is like, you know, if you put some pollen or something on water and when it kind of dissipates, or if you look at the dust on a ray of sun or light, you can see the dust particles move away from the impact with each other. And we can actually infer statistical properties from that motion, and that essentially is called Brownian motion. And that Albert Einstein used it in physics, but we're going to use that same methodology in quantitative finance, and it's heavily taught in almost every financial engineering and risk management courses, and that specifically is geometric Brownian motion. So this is the equation of a geometric Brownian motion. So how the equation is derived, that's a completely different journal. It's very elaborate, but I'm just going to explain what this equation is. So this is the stock price at time t equals the initial stock price multiplied by exponential of the mean, which is the mu, which is the drift, minus sigma square, which is the standard deviation, to the power 2 divided by 2 asterisk time plus standard deviation into BFT. So BFT is that Brownian motion. So BFT is that thing that I told you about, the particles moving around. And sigma is kind of like the wiggle. Sigma is like the wiggle. So how far away can it go? So for example, if I'm say working out, if I'm running and I'm calculating the deviation of how far away am I doing the right form. So that gives you the standard deviation. The standard deviation is so high that my running form can be all over the place. The standard deviation is so small that means that my running is kind of smooth, kind of in a perfect form. So in 2008 recession, the standard deviation will be much higher as compared to other data intervals as well. So the standard deviation is pretty critical, but we've already got the mean and standard deviation. Mean can also be inferred as the expected return. So there are drawbacks of the geometric Brownian motion. So one of the biggest drawbacks of the geometric Brownian motion is that it takes constant mean and constant variance. And that is a big issue because we have just got the mean and variance for this data. So that does not mean that next year or in the 2001 recession, the mean and the variance will be the same. That is one of the biggest drawbacks of the geometric Brownian motion. But just by using this, we can generate lots of data, and that's what the strength of the geometric Brownian motion is. We can create more data using a normal distribution, and that can help you create models for expected returns, models for volatility, and different kinds of scenarios. So I've written in capital letters, assumes logarithm returns of the asset follow a normal distribution and asset prices evolves over time with the constant mean and constant variance. So that is the geometric Brownian motion. So now let's create a geometric Brownian motion model. So the first model was a simple Monte Carlo model, which has the assumption of a geometric Brownian motion. But now we're going to create a pure geometric Brownian motion using this equation here. So again, we are importing the libraries, and then we're going to store the mean. We're going to put in the number of intervals, time in years. So roughly 250 days multiplied by 4 is 1000 days. So we're just going to put in 1000, the number of intervals. Now time in years is 4. Again, this is just, I'm just putting some numbers here. You can keep on making the changes. Again, the code is available in the description if you guys want to download that. So the number of simulations we're doing 1000, and the initial stock price, as discussed before, is 400. Sigma, we've already got the standard deviation from the 2008 data, and we are storing it into sigma, and we're going to calculate each time step as well. So dt equals t by n. So t is number of years divided by 1000. So we can get the time step. So each time step, the model is going to predict where the stock price is going to be. So now you've got the dt and all the other values, and now we're going to use, I'm just going to put random seed as just a comment as of now. I'll explain to you in a bit what that does. So now we're going to do is we're going to create that equation. So first we're going to code this part of it, which is exponential part. So we can use the numpy and np.exp and then mu minus sigma, just basically the equations, and then storing the Brownian motion and the standard normal distribution. So you can see the random normal distribution there. And then we've got st, and then we need to do x0 into that. So that's basically put in s0, which is the initial stock price, into st.com product. So that basically what that is com product is like multiplying each value of that array. So for example, if you have 2, 4, 6, 8, the first value will be 2, the second value will be 4 into 2, 8, and that that cycle keeps on repeating. Again, I've discussed that in the algorithmic trading 0 to hero in Python. So if you don't understand that, it'll be great if you could go back there and pick it up from there. So now we need to calculate the simulation. So again, we're going to use a for loop. So we can use a for loop, and then we're going to store the stock price and then into df, and then calculate the simulations of that geometric Brownian motion and store it. And now we're going to plot that, and as you can see, here we go. There is the geometric Brownian motion simulation. Again, 1000 simulations we have created, and we can actually backtest different strategies from this stock price generator. So again, I'll go back to the thing that I told about the random seed. So what random seed does is that every time I do a test, you're going to get a different result, and that's the whole process of being random. So now if you put the np.randomSeed as as a comment, what you will see is that after running the geometric Brownian motion, we'll get the geometric Brownian motion here, and if I run this, note these values here, 399.56, 58, and 57, you can see the numbers have changed because every single time there's a new random generating numbers going to take place. So if I can make it fixed, so it can help me in the future test if I want to. Let's run that code. It'll take a while because we're doing 1000 simulations. And now if I take in GBM, so look at the numbers, 399.56, I'm going to run it again. again exactly 399.56. So if you want fixed numbers, you can put in random.seed 42, but obviously every simulation will give you different results, but it's just that for each simulation, if you want to have the exact same result, then using the random.seed would be a good idea. But again, it's up to you. I just want you to know that, so when you're creating different functions, doing different kind of Monte Carlo simulation, if you want to have similar test results, then doing that would be ideal. So again, we've created 1,000 simulations using another model, which is Geometric Brownian motion. Now, how about another model? So let's create a Heston model. So Heston model is slightly more complicated than the Geometric Brownian motion. So the problem with Geometric Brownian motion is that it doesn't capture volatility component. So as you know, stock prices are dependent on volatility. So volatility is not a constant. GBM kind of takes into account that the volatility is a constant. So Heston model gives us the advantage that we can actually add variations, we can add volatility to the volatility, and we can also add inputs of mean reverting, because that's similar to what happens in the real world. Because in the real world, you can see expansion of volatility, and then the market comes down back to the mean, and then expansion of volatility, market comes back to the mean. So we can use that to generate data as well. So again, here we've got the NumPy, the typical libraries, and then we've done different inputs. So here, kappa, we have put in 2, which is basically the mean reversion speed. So how quickly does it go back to the mean? Again, these are just input values. You can put your own values as well. So then we calculate the theta, the long-term average variance, the volatility of volatility, which is the standard deviation that we calculated. We've also taken into account the correlation between the stock price and its volatility. That's another advantage that the Heston model has over the Geometric Brownian motion. And then we're just going to put in the parameters, the time interval, but note this one as well, the risk-free interest rate. So that is also taken into account in a Heston model, which on the other hand, the Geometric Brownian motion is not taken into account. So then we're going to simulate this. So this one we're just going to do 100 simulations because it's a bit complicated model. You can put in 1,000. It's going to take a while, so I just want to make this as fast as possible so you can understand. So the equation is kind of complicated, but I'll try to explain it to you as simple as possible. So first we're using a DZ1. This is used to model the randomness or noise in the volatility process. For that, as similar to the previous one, we're using the normal distribution, random. And then in order to introduce the correlation between the stock price and the volatility. So stock price and volatility has got a specific correlation, because normally when the market goes up, the volatility is not that as high, but when the market goes down, the volatility is quite high, and that is how option traders tend to make money, through theta, decay, and vega. So once we calculate DZ1 and DZ2, then we need to introduce the mean reverting part of it, how the volatility is going to collapse. So that is where we calculate VT, or we use kappa and theta, and this massive equation over here. Again, how this equation is derived is beyond the scope of this video, because that's more complicated. All we know is these are some great equations created by great mathematicians, and we're just using that for our own benefit to create data. And then basically we're just using the loop, for loop, and then calculating the Heston model. And we also use the Geometric Brownian motion here. You can use the 0.5 VT and the you see the DW as well. And then we are going to plot these Heston models. So you can see the Heston model here. It's got like 100 odd simulations. Now there's a problem with the Heston model, and that is also one of its advantages, and that is the risk-free rate. So risk-free rate here is a constant, but as you know, including this year, the risk-free interest rates keeps on changing. So that means that every single time the risk-free interest rate changes, you have to create a new model. And that can be a bit frustrating as well. So you've seen all these 3 models. You've seen the Heston model, you've seen the Geometric Brownian motion. You can also see the simple Monte Carlo method. I like to use the Monte Carlo model because it's quite simple. It has the same behavioral characteristics of the specific time period that we are targeting. So here, what we're targeting the Monte Carlo model, we're specifically targeting a specific behavior, and Monte Carlo methods are quite simple. Geometric Brownian motion is also quite simple. There are many different models. There's jump diffusion model, which I'll discuss in another video. So these are all ways for which you can create more and more data, and you can backtest your strategies on this data. So this is one of the strategies that we did in our course, which is basically a mean reverting strategy. And the reason why this strategy works so well, including in the recent past, this strategy was given 2 years ago on our course, and it's performed splendidly well in the past 2 years because it's in a recessionary period. It's not because I'm a rocket scientist or something. It's simply because it has been tested across multiple data points. So when I come up with a strategy, I'm not just coming out of the strategy saying, oh yeah, if this goes below this number and that goes below this number, then trade. There's a consistent process involved in finding the data, finding the process of going through the optimization of forward testing. So in simple quantitative models, you can actually do the back testing, and you do the forward testing, and you do the Monte Carlo simulation of the trades, and then you conclude that a strategy works. But when you generate more data through the Monte Carlo methods, through the geometric Brownian motion, now you've got like millions of data points, millions of data, which you can backtest this exact same strategy and see whether it works. And if it has got similar characteristics, similar return and similar drawdown, it doesn't have to be exactly correct, but when you have that similarity, let's say the maximum is like 30% and the minimum is like 10% and the maximum return is like 700, the minimum return is 700, the maximum return is 1,500. It has got a similar characteristics traits. You can calculate the average return and average drawdown, and then you can conclude that this strategy works. So this mean reverting strategies, because it's trained well for the recessionary environment, you can see this is during the 2001 dot-com bubble. It's the exact opposite. And again, during the 2008 recession, this is the buy and hold equity, the blue line. And again, in the 2022 recession as well, which we are going through right now, again, the exact same opposite end of the spectrum. So for me, recessionary environments are really great advantages point. So even in the book, The Man Who Sold the Market, if you can go to the last page, the best performing years for Jim Simmons has been years when the markets are kind of in a recessionary environment. There's volatility is crazy because it's quite easy to make money during recessionary environments. And for me, it's kind of, it's good in both worlds, because not only can you make money because it's mean reverting, but also when the stock market is completely down, you get lots of great companies which you can invest for the long term as well. So hope you guys got a gist of how we can create lots of these data and how these data can facilitate for you guys to create far more efficient strategies that you can use to trade the financial markets. So if you guys have any questions, feel free to give a comment or send me an email, and I'll try to respond as quickly as possible. Hope you have a great day. Bye-bye.